At that point in time, with the markets being there, it was just a crazy time. It was difficult to convince people to get into equities. A very small percentage of people have been able to take advantage of this journey. As you rightly pointed out, that most people did not stay invested because we're just not wired to be able to, stillness is a virtue in investments. As human beings, we are just sort of programmed to mistake activity for productivity.
Naveen, can you give us some glimpse into a 23-year stint at HDFC Mutual Fund?
That is right. It's Puri Javani Dedi. I've been very, very fortunate to have had worked with leaders like Milind and Prashant. So Milind, was the CEO of HDFC and
Milind Barve.
Milind Barve, yeah. And I think the two things that I learned from him.
Hello and welcome to Mint Money Talks. I am Neil Borate, personal finance editor at Mint. And today I have a very special guest, the man who was number 2 at one of India's largest AMCs, possibly the largest. And Naveen, at that time, how large was HDFC Mutual Fund's assets when in your last year at the mutual fund?
When I left about 3 months back was 7,75,000 crores.
So, somebody who oversaw assets of that humongous size and is now starting new innings. So you tell us all about that. But before that, Naveen, can you give us some glimpse into a 23-year stint at HDFC Mutual Fund?
That is right. It's Puri Javani Dedi. 23.
But you still look Jawan, huh? So
Yeah, so 23 years at HDFC. I started out as a management trainee just when the firm was forming or had just formed. And it's been a long journey and a fruitful one.
it had acquired Zurich, right? That was the beginning.
I had joined before that. HDFC acquired Zurich June 19th of June 2003.
Right.
And I joined a year and a half prior to that.
And was Prashant Jain already there or did he join afterwards? What?
No, he came when HDFC acquired Zurich. So he came, he was one of the acquisitions.
And that's when a lot of the iconic funds date from, right? So Balance Advantage Fund,
That is right.
HDFC Equity Fund, all of those.
That is right. It used to be called the Prudence Fund, which is now the Balance Advantage Fund. That was a Zurich product. And the equity fund, the FlexiCap, as it's called now, was the Zurich Equity Fund.
Yeah.
So and so forth.
And that was actually quite a bearish time, right? Because the dot-com bubble would have burst and it would have been pretty hard to get people into those funds at that point of time.
Yeah, in fact, it was difficult. And let me just step back a little bit. So when I joined HDFC, at that point in time, this is back in 2001, 2002, we had the foreign funds, which were, considered as very sexy and hip. So you had, of course, Zurich, you had Merrill Lynch, you had Templeton, you had Sun FNC. And I remember as a relationship manager, I was setting up the banking distribution at that point in time. And I was the last one called inside because we were not hip. And in a way, it was like, motivational and also gritty for me to say that I should be the one called in first and I would wait outside and build that relationship. But yeah, you're right. At that point in time, with the markets being there, it was just a crazy time. It was difficult to convince people to get into equities.
And I say this especially because, you have these news items that XYZ fund completes 20 years and makes 1 crore into 20 crores or some such. And the truth is, people didn't have that much money to begin with at that point of time.
Yeah.
And very few people had the patience to stay with the fund for 20 years. Like you had a challenge selling the fund at that point of time. Although I'm sure you've seen your share of remarkable investors who have stayed the course and happy to hear from you about that. But it's not as easy as it looks is what I want to.
Neil, unfortunately, a very small percentage of people have been able to take advantage of this journey. As you rightly pointed out, that most people did not stay invested because we're just not wired to be able to, stillness is a virtue in investments. And as human beings, we are just not able, as human beings, we are just sort of programmed to mistake activity for productivity.
Yeah.
And unfortunately, that's what has happened. And you're right that, so say forget about like 10 lakhs investing and becoming 20 crores, 1 lakh has become 2 crores.
Yeah.
Big enough. I mean,
Yeah. Of course.
many people would have had that kind of money to invest even then.
Yes.
But people have not been able to take advantage of it just because of the fact that we are constantly trying to move and mistaking activity for productivity.
Yeah. Tell us about working for Prashant Jain. What was that like?
Oh, I've been very, very fortunate to have had worked with leaders like Milind and Prashant. So, Milind, was the CEO of HDFC, and
Milind Barve.
Milind Barve, yeah. And I think the two things that I learned from him was one, his clarity of thought, just unbelievable. And the second thing is that, as they say, that the chain is as strong as its weakest link, and he would take a weak team player and put him in a place which is strongest for him, and that's what made the chain impenetrable. And I think that's why the team stayed on for a long period of time. And in our business, the financial services business, it's about processes, performance, and people. And within people, it's not only quality but also the longevity of people. So I think Milind was that. And as far as Prashant goes, I mean, he's an absolute legend, ahead of the curve. His work ethic on putting processes in place and following those up, and he's been ahead of the market. So whether it was the dot com bust, he was ahead of the market in 2008. Stayed away from NBFC capital goods, and now with PSUs, I mean, at some point in time, or value stocks, where HDFC was overinvested or Prashant was overinvested, and we got a lot of flack for it.
I remember.
It's all played out beautifully. So yeah, he's fantastic, and the learnings that I've had from these two gentlemen actually has given me the courage and hopefully the right ingredients to be able to do what I'm doing now successfully.
What was your most challenging time at HDFC Mutual Fund?
08,
Okay.
the GFC. It was a really, really difficult time at HDFC at that point in time. And I was looking, at that point in time, my responsibility was head of institutional sales for Mumbai, which is by far the largest market for institutions. And that was a really, really challenging time.
But they say that institutions are the smart guys, right? They're the ones who stay put and are patient. The retail guys are the fools who get out.
But this is fixed income, right? So
Right.
this is not. So the fixed income was a huge issue, and I think that challenging time, my challenging time at HDFC, actually, that's what brought out the best in me, because at that point in time, if anybody could bring in money, was
A brand like HDFC.
well, brand, and also you need to have. So I mean, I stood out because luckily I managed to get a decent amount of money,
Right.
because there was a mismatch in liquidity.
So with Creed Capital now, what is the idea? The second innings for you. So can you tell us a bit more about it?
So Neil, if you look at Indians, we tend to have the maximum number of financial goals. So, namely, we've got education and marriage as two incremental goals as compared to foreigners. And now you look at and also medical health. So here I'm not talking about health insurance policies, but in general. And you look at education and medical expenses are inflating at more than 10%, right? And now you combine that with the way Indians are investing, it's totally lopsided. And there is hardly any goal planning that goes into this for Indians. And I think there is a massive opportunity to be able to try and correct that. And also it is linked to purpose. I mean, if you want to, I'm figuring out, I mean, most people try and retire early. I'm figuring out a way how not to retire. So that's the idea with Creed.
Yeah. I mean, you could retire if you wanted to, but you still, I mean, you have sort of had such a long career and it's successful financially that if you wanted to, you're free. But
yeah, but I think I mean, this is a purpose. I mean, you have the ability to be able to make a difference to somebody's life, and this is real. I'll tell you another very interesting thing. See, what would happen 15, 20, 30 years later is that we would start working at 21 years of age and we would retire at 60 and life expectancy was 70 years. And so your retirement was a small, it was from 60 to 70, 72. Suddenly there is a massive psychological and biological change. You start working at 25 now. You want to retire at 45 and you're living till 85. And unfortunately, we're not planning for it.
Yeah.
And that's the big change. And I see that as an opportunity. And I also see that as something that one can help people achieve their financial goals if there is somebody who's straightforward, trustworthy, transparent. To my mind, that's what I want to do.
Right. Now, Naveen, you've chosen distribution as the main model for the new business, although I think you're also open to advisory.
Yeah.
Over time, have you seen a small shift towards advisory or not? Or like how do you see these two models going forward?
How I see them going forward, it really depends upon the SEC that you are targeting. So if you're going at right on top, there I think the advisory model is a good one. But if you're going in the middle, if you're hitting in the middle, then I think a distribution is a far
So, what would you
superior.
put the cutoff at in terms of net worth? Like above what amount should?
No, so if you're going like maybe 10 crores, 15 crores and above that, then maybe advisory is a better one. And within 1 to 10, 15, I think distribution is better. And again, below one, distribution model, but a lot of people are just going direct. It's do it yourself. But to my mind, I think this business has to be handheld. So the way I equate this business is that, let me just equate this to a sporting analogy. I have never come across a sporting team or a sportsman that has achieved anything meaningful without the help of a coach. And my core belief is that it's the same for financial plans. You need to have an outside, inside view to a financial plan. And, I can extend that to fitness. You need to have, why do people have trainers? You need to have somebody who's spotting you. And I'm a big believer of that.
Well, let me just close this off by one issue that often people bring up in the conversation around MFDs, which is that commissions sometimes do influence the choice of funds recommended. So, how do you credibly commit to clients that that's not going to affect your choice of recommendations?
I think there is a massive amount of transparency in this business. It's highly regulated. And yeah, if that's the driving force for somebody, you're likely to lose the client eventually. And that's what I think. This is such a massive business. You're doing a good thing. It's a let me tell you that it's asset allocation that sort of delivers 92% of the returns and not stock selection and market timing. And therefore you are doing asset allocation. So you've got game from that point of view.
So, the choice of funds is not so important as the choice of assets.
Totally. And therefore, there is no need to do something like that. And if there is someone who is getting driven by the commissions and the retrocession that is going into it, it might get caught out, in my opinion, over a long period of time.
Clients,
Yeah.
get smart to it.
Absolutely. It's a transparent business.
Now, one of the analogies that you often draw is between sports and investing. I remember in your presentation recently, you talked about persistency as one trait that sports people have and that investors should have. So, could you elaborate on that?
If you look at, let me give you an example of a very interesting article that I had read by Morgan Housel. And what he did is that he sort of analyzed the training schedule of marathon skiers. And they're some of the fittest sportsmen in the world. And he bucketed their training in high intensity, medium intensity, and low intensity. And what he found is that the maximum amount of time they spent, 90%, 87% of their time they spent in low intensity, and only 5% of the time in the highest intensity. So the takeaway from that is that look at us as investors. Most of the people are trying to blow the lights out. That I want the return, the best return in the shortest period of time. And that's not what is happening with sportsmen. What they are doing is that they are training all through the year. And imagine 90% of the time at their lowest capacity. So the learning out there is, I think, that don't chase the highest returns, but chase the longest period of time, which is sustainable. Let me add to that. So if you look at Warren Buffett, of course, is one of the richest men in the world and also the best known investor. There is another gentleman who passed away recently, Jim Simmons. Jim Simmons compounded his wealth at 60% or something like that, and Warren Buffett is at 18%. But Jim Simmons' net worth is about 35 billion, whereas Mr. Buffett is more than 200 billion. And the difference is because Mr. Buffett started investing much earlier. So compounding is something, every time I look at the numbers, I'm just totally amazed with it, no, time and time again. In terms of grit, I think the first time I ever came across the word tenacious was on the walls of Roland Garros, which says victory belongs to the tenacious. And then came along Rafa Nadal, who's the most tenacious sportsman to me ever. And I think you just need to stay in the game. I mean, the reason Rafa Nadal may not be the most gifted, arguably, as opposed to some of the other people, he's definitely got a lot more grit than anybody else, and he stays the course. And I think as investors, those are the learnings that you have. So whether it was the .com bust, whether it was 2008, whether it was COVID, these were opportunities for people to invest into the market. But unfortunately, people were pulling out. And I think that's the correlation that I was trying to make.
Yeah. And we might be approaching a period like that now after many years of a fantastic bull market. And I think there could be people who've gone overboard on small caps, on thematic funds for sure, if you look at the data
Yeah.
in the past year.
Yeah.
So how do you see the right approach now?
Not only now. I think I'll tell you what happened with me. In 2001, I lost money as well in the .com bust. But that taught me a great lesson. And I went to a boarding school and I played a lot of football. And I started sort of over the years, I started analyzing that every batch, there were batches in that boarding school. So whenever we had a superstar football team, and superstar typically meant that you had the forwards who were scoring all the goals, our results were very bad. As opposed to when we had a team which was balanced and not full of superstars, tended tend to do did much better. And my thought was that how do I correlate this to a portfolio? And a balanced portfolio tends to do much better than something which is extremely aggressive. And what I learned is that it makes sense for you to be, and for me, what I did for my portfolio is that I said that let me be at 75%, 25%, and just stick with it, like a football team, which is totally balanced. And not surprisingly, it turns out that a 75-25% portfolio captures 91% of the equity return with half the volatility. And that's what keeps you stay long. Coming back to the point you mentioned, I think you're right that some of the portfolios have gotten overloaded with thematics, and it's not a good thing.
So Naveen, is that the allocation that you've kept for most of your investing life, 75-25? It's a modified version of the classic 60-40 portfolio.
Yeah, that's what I've done. And in a way, I was lucky to have gone through that bad period very early in my life. The amounts we're talking about is not much, especially 25 years later. So I was lucky to have gone through that period. And of course, being in the business for so long and having the ability to sort of think laterally, that's where I landed up, and that's where I want to stay, and that's where I have been. And it's worked like magic.
But have you rebalanced over the years? Do you have a rule that if markets go up by so on?
Exactly. So that's what I've done. So that's the reason why in 2008, when people were selling, I was buying. And that is the reason in COVID, when people were selling, I managed to buy, and not because of anything else, not because I'm smarter than anyone else, just because I focused on that asset allocation. And that asset allocation genuinely works really, really well. One, because you're not thinking, you're just going according to, you're disciplined about it. You're thinking in a disciplined fashion. And I think that's the differentiator in any portfolio. And that's the differentiator in creating wealth over a long period of time. And this is the reason why all studies say that it's asset allocation that creates wealth for asset allocation, and 7 or 8% for stock selection and market timing.
But a couple of things that you would have had to deal with in your career. So, you would have got a lot of ESOPs. So, did you correct, because that would have skewed your equity allocation by adding more to debt?
Yeah, I did that.
Okay. And in terms of fund house, did you have a rule that you had to only invest in HDFC funds, or was it a choice?
No, we did not have a rule that we had to invest in HDFC funds, but most of our money was with or is with HDFC funds because, I mean, they're fantastic funds that run by fantastic people.
Yeah, absolutely. Before we finish, Naveen, any thoughts you'd like to give to our viewers, especially first-time investors?
Most of it I have already said. I think it's extremely important to have a balanced portfolio and stick with that balanced portfolio because markets are gyrating, and it's only we've had like 9 years of a positive market, but that's not the characteristic of markets in general. They're more gyrating than they have been in the recent past. That's one. And the second, like I said, that there is no sportsman that's achieved anything meaningful without the help of a coach. So it's important to have somebody who's overlooking your portfolio, who you trust, who's transparent and straightforward.
Sorry, I mean, a couple of things that I missed out. One is on global diversification. So, most Indians are very skewed towards the home country.
Yeah.
And, if you think about it 15, 10 years ago, it made a lot more sense. We had a huge runway, we were growing really fast. But as our market matures, is there a stronger case for a global diversification? And do you also implement that in your investing style?
I do that, but it's more to do with kids' education. So you want to, so it's more from that point of view. If you take a 10-year, 15-year view, to be honest, I am with the majority thought that India is going to be a country which is going to deliver one of the highest returns. I mean, we have delivered over a period of last 20 years, 15 years, 10 years. We've been between the best performing to the third best performing equity market in dollar terms. And I don't see that changing, in my opinion, over the next 10, 15 years. So the diversification you might want to have is because you have like expenses from an education point of view, etc. Yeah, so that's, I think, basically what my thought is. But otherwise, to figure out good places to invest in on your own outside is difficult enough within India. So imagine if you have to go to Europe, Japan, and the US.
Right. And with most of the mutual fund industry hitting the RBI limit, do you suggest the LRS route, or what is the best option among the bouquet available?
So because there is no limits available at the moment except for with some fund houses, the LRS route is a good one to go with. And I think now there are a lot of options that are opening up via Gift City as well. So that's a good way to do it as well.
And another asset class that usually gets missed out in the equity debt talk is gold, or broadly commodities. Gold and now silver also. There are silver funds in India. Do you have that as a hedge?
I do. So I have about 10% exposure to gold and silver, and I try and keep that at 10% between the two of them on a consistent basis. So of the 25%, 10 will be commodity.
Right. And that also helps you protect against inflation.
Absolutely. Absolutely.
Great, Naveen. I wish you the best of luck, and thank you so much for taking all the time to.
Thank you so much. Thank you for having me over. Thank you very much.